All right, good evening and happy Monday, everybody. John Whitford here from Side Hustle Investing, and I wanted to go live tonight and cover a concept that really hit me front and center today. So, as I was going through my day, I was looking at my net liquidation value, and I had, gone up over 1% in my overall net lick over the course of just about a week or so since I've been doing these live videos. So here I am thinking that, the world is good. I'm just going to go straight up and it's going to be all sunshine and roses. Well, of course, the market has a way of kind of bringing you back into perspective, bringing you back into reality. And I learned something about my Strangle trade that I had put on in GDXJ a little while back. And so as we go through and do a quick little portfolio review, you'll see I've got one, extremely clear outlier here at a 90% loser on this side here. Everything else is doing okay. Time is working in my favor, so these are all starting to turn more and more positive. But that GDXJ, there's something going on here. So I wanted to take this video and not go through each position. I will cover the one position that I entered today and why I did that. But I wanted to talk about how you can manage strangles without feeling like you're being strangled with anxiety. Haha, good pun. But really, if you're mechanical about this, you're going to be okay. Even if it ends up being a loser, you have ways of managing the trade, and I'll show you what my plan is as I go through this. And as future videos come out, and as I continue to kind of document this process through my options learning, you'll see not only the mechanics, but also some of the psychology and the reasoning that I can go through with myself to make sure that I don't, freak out unnecessarily. All right, so real quick, let me cover the new trade that I went through today, and then we'll get into the meat of the live stream tonight. So I did open a position in CSX, the good old-fashioned railroad. And fun thing about this, I actually have a family member and several friends who work at the corporate headquarters of CSX. And there's a lot of talk going on about a hedge fund coming in with a hostile takeover, and just a lot of talk around that. So I took a look at it in the grid, in the watch list, and I saw the volatility at the time that I placed the trade. If I will look at the current volatility here, is in the 86th percentile. I follow percentile, so that's IV percentile, not just rank. And I've got my own reasons for that. There's a previous live on why I do percentile versus rank. I'll let you guys check that out when you can. But basically, it was a good time to be selling some premium in CSX. So before I'd gone through with that trade, I'll take off my order, and you can see that my portfolio beta is really not that bad right now, but I'm sitting there at, let me see if I go this way, at 2. I was slightly bullish, but really not that bullish at all. When I was actually placing the trade, my portfolio was around, I think I'd say it was 7 to 8. So let's say 7 to 10 portfolio weighted delta. And so I really did want to rein that in and bring that back to being more realistic. So my go-to move in that case would be a credit spread, whether it's a credit spread, whether it's on the put or the call side. So for this position, my choice was to go for a credit call spread. It also made it easier to do that because if you look at the chart of how CSX had been going, you can look at their 52-week. And since that news had come out and there were earnings and just so much stuff happening for CSX, it's been a rocket going right up. So being a little contrarian, looking at how it was oversold at that time, I thought it was a pretty easy play. Just go and make a standard 30%, 30 delta credit call spread. And so that's what I did. And that position is, let's see what it's doing right now. So if I collapse this, overall, it's a little bit of a loser, but that's kind of a misnomer. As you guys all know, time is on our side on this one. So I'm just going to watch this and make sure it doesn't go too far beyond the short strikes. And we'll talk about managing those trades in a different video. So the meat of today, let's go ahead and clear out all of our accounts and go into our GDXJ position. And this is not looking so good. It's not too pretty. Let's make this a little bit bigger. So basically what we got here is I am seriously being tested on this call side of my Strangle. So if we look at the chart of GDXJ, let's go ahead and click it. So now I've got my chart pulled up over here. The trade was placed, and let's go check that out real quick. So if I filter down to GDXJ already, because I knew I wanted to talk about this today. So the original trade was placed on January 27th. And as you can see, the price at the time was $38.89. It's now $42.29. So that's a heck of a run up. And that was on the 27th. So if I look here and I look at the last 30 days, 27th or so. So I placed a trade on this day. Man, this makes it even more obvious of why I'm in the position I'm in. So if this was my start time, this is the movement that the ETF has done in that time. So my short strikes were here at 43, and my other short strike, it was way down here. I think it was at 30. Let's go ahead and check that out real quick. The original one was at 30 and 43. So I started testing that a while back. So what my first move was, and let's go ahead and go through the steps here. So the first one that I want to talk about is when this happens, don't panic. If you panic and you start over trading, you can end up whipsawing yourself where you'll make an adjustment to anticipate the worst and just the opposite will happen and the ETF will turn around and then you'll get hit on the opposite side. So number one is don't panic. Oof, handwriting's not the best tonight. Number two is you don't want to adjust prematurely. That sounds kind of bad. I should rephrase that. But you want to wait for the right time to start your adjustment process. And it is a process. It's not a discretionary thing. There's a mechanical set of rules. So what I like to look at is if I'm trading the March expiration contract, which is the case in this one here, I want to wait until at least March 1st or so, to start placing adjustments. And now I say that, and then in this one here, you're going to see I actually already broke that rule. But the mechanics here, what I'm trying to teach is that you want to wait until you're about 3 weeks or so away from expiration before you really start placing your trades. And the reason for that is there's a lot of time between expiration and the trade entry in a lot of cases, 45 to 60 days sometimes. And if you start adjusting too early, there's a lot of time that's on your side. That's theta decay that's going to help you. That clock is going to slowly decay the value of your option contract. And so if you start making adjustments on day one or 2 or 3, that's a lot of time, a lot of value that you have pent up in this. And as we'll talk about what that adjustment could be, you'll see that you're really hurting your opportunities of staying in that profitable zone by adjusting too early. So step 2 is to wait for the right time. And a good rule of thumb is the same when the month begins that the monthly contract is going to expire in. Now, again, if you're trading weekly options, just be smart about it. We're looking at about 3 weeks out or so. So if you're in the first week of the month, obviously you don't wait for the first of that month to start making adjustments. So just be smart about it and wait for about 3 weeks or so before expiration. Another point about that is you don't want to wait too long either. And this is where it starts to get a little complicated because, like I mentioned before, time is degrading the value of those options. And whenever you're going to be placing a adjustment, you're going to want to be collecting a credit for that trade because, as we'll talk about here, let's go ahead and talk about it now. So if you have your position, your strangle looks like this, right? So when your short strike starts to get breached, let's say you start getting over here, your delta value for that short strike is going to approach double or so. Let's say it's 2x the original. So if you place your deltas at 0.15, they might turn into 0.30. This starts to become a very optimal time to start placing your adjustments. And there's been a lot of data that goes into that. But really, you can use 0.35, whatever the case might be. But this would be a good target for you to start with. So when you place that trade, what you want to do is you want to give yourself more room to be right. And what that means is, as you know, let's say that your profit loss is right around here. The height of this area is equal to the credit that you took in, right? That's why you make money as an option seller. So if you were to pay something to make an adjustment, you are in effect reducing the amount of wiggle room you have. You're reducing the amount of credit that you've received on that overall trade. What that also does is, let's say this is here, for my example, this is at 43. The distance, I'm going to get a little geeky in math here on you, but the distance between the strike price and your break-even point, we'll call this BEP, well, that has to be equal to, hey Susie, that has to be equal to the credit that you received. And then you can start doing some Pythagorean theorem. You can do the x squared plus y squared or whatever the case might be. But essentially, the distance between this point and this point is all dependent on the credit that you received. So when you take in a debit, I know I'm beating this point home probably too much, and you guys get it already. But when you pay a debit to make an adjustment, you are hurting your probability. You're pulling in that profitable zone. So by taking a credit instead on the adjustment, you're doing the exact opposite, right? You're lifting that point up. You're lifting that plateau up. And so what that does, if you don't move this untested side, if you don't move the tested side, which means the side that the stock is pushing up against, if you increase the credit by doing something on this side of the trade, what you're doing is you are expanding out ever so slightly, it could be, but you're expanding out your break-even price, your break-even point here. And that's what we want to do in trades. From the big picture perspective, when you're making adjustments, you don't want to always achieve your max credit. You don't want to totally turn it around and make it a huge winner. Oftentimes, you just want to come out even, or even just reduce the amount that you lost by a little bit. If we think of options trading, when you see the numbers on the paper, it looks like a zero-sum game. If you got a $1 wide credit spread and it's a 30% chance of failure, you're looking at making $30 and losing $70. It's a zero sum. But by doing small things like adjusting this to where a loser becomes less of a loser, or by managing winners and slightly increasing your probability of profit, all these little activities that you do are just tipping the scales in your favor. So that is the overall goal, to turn this not into a zero-sum game, but into a business that you can be successful and sustainable in. Okay, so that was kind of a long answer for number 2. Was waiting for the right time. So number 3 is, and I'll have to draw this again because I kind of had fun with it, but the goal is to roll up the untested side to your target delta. So let's do this one last time here. So if you've got your strangle, and let's say that you set it at 0.15 delta and 0.15 delta here. Well, as the strike moves, or as the stock price moves against you, there will be that time when that 0.15 becomes a 0.3. And again, this is all rule of thumb. You'll be able to develop it over time. So that's what happens on the call side in this example, and what happened to me in GDXJ. So what happens then to the delta of this put strike? Well, this, I'm not entirely sure where it's going to fall to, but it's going to fall from 0.15, let's say, to 0.08. Okay? It could be any number, but it's going to be a number that's smaller than 0.15. So what you're doing to how you mechanically adjust this is, the goal is to close this position. So we want to basically erase this off the map. And you want to reopen the same number of contracts. So you're creating the same exact curve here, but you want to pull it back in to your target probability, your target delta. And so if you started with a 0.15, you want to find wherever that new 0.15 is and leave that one there. So you'll have a graph that looks like this. The only difference would be you might take in a credit of, let's say, $30 to make that adjustment. That would be a pretty standard one that I've seen so far. So what that's going to do is that's going to increase the plateau here up by $30. So you're going to have a thinner profit window, but it's going to be higher up, which will help you if you're trying to scratch the trade. It'll allow you to be less right and still come out as a net zero or a smaller loss. Hope that makes sense. All right, so that's step 1, is to roll up the tested side. So the next step, let's call this step 4. If your short strike gets totally breached, let's say you're over on this side of the trade, moving up a little bit, that will give you some incremental credits. But the last point that I recommend, and that I am going to do in this position, if this continues on with this rally, is I will turn this iron condor, this more narrow iron condor, into an iron fly. And I'll do that again by closing this position, closing the untested side, and I'll reopen it at the same short strike as what has already been breached. So here would be the 43 strike price. So I would create an iron condor. I would create an iron fly, and that would, again, it would increase my credit dramatically, and it would give me a chance that if the price were to come back around, I would have the opportunity to close out at the new break-even price for my trade. All right. So step 5, and this kind of happens all along the way. It's not just in step 5 that you do this, but every time you make an adjustment, you want to keep track of the credits that you've received along the way. And this is very, very important because the brokerage platforms don't do a very good job of this for you. So for example, in this trade that I made, the initial trade, I took in a credit of $1.21. Let's go ahead and open up our calculator. So that was my credit on the initial trade. And as time goes on, I made my first adjustment, which again was to roll up that spread. So I bought back the 30 put and I sold the 33 put, and that gave me a credit of 38 cents. All right, so I'm going to go ahead and add plus 38. So now the overall credit that I've received on this contract, or on this trade, was $1.59. So again, if we go back to what our profit targets are, which is 50% of the trade, if I were to look at my portfolio screen, this is not going to show me. It's going to show me a trade price of $133 or $1.33 per share. That's not the same as $1.59 here. So what's happening in the platform is it's only showing the credit of the actual legs that are being displayed. So when I closed off this contract that was a loser, that leg that was a loser, and I pulled it in, there was a credit taken in during that transaction, and the platform does not show that for you. So this is just a very good rule of thumb, is to keep track of this, whether it's in a ledger, in the built-in Analyze tab here in the web platform, or just on a freaking notebook. It's just fine. And keep track of all your credits received so that you can then better calculate your profit target and your break-even price. So for example, if I just wanted to break even, if I just wanted to get out of this thing without taking a haircut, which is probably going to be the goal on this first trade, I'm going to be able to change my good till canceled order to $1.59 debit. So if I were to do that here, let's go ahead and make that adjustment here. So I'm going to close at a profit percentage. And if I were to, again, put in 0 here, or 1% profit, it's going to inaccurately try to close it at $1.32 debit. But we just looked at the credits we received as $1.59. So I could put this in at $1.59. Look at review. It's going to show you a realized loss, but don't freak out because you've already closed one of your legs at a profit. So this would be a net 0 trade. So I'm going to go ahead and send this one off. And there you go. So that's step 5. The final thing to keep in mind is as time gets closer, if you get closer to expiration and you've got a loser on your hands, you have to make the decision. And the decision is a pretty simple one, but it's one that only you can say. And it's, do you roll or do you close and take the loss? So rolling in this instance is referring to rolling out in time. And you're going to move it, let's say, from the March contract into the April contract or the May contract, whatever you think it might be. And that's kind of the beauty of options, but it's also the double-edged sword is if you roll out, you're giving yourself time to be right. You know, every security is cyclical. You know, things go up and they come back down. Question is, how much do you want to bank on that happening in a realistic time frame? Because it could be where you would roll out and roll out and roll out, waiting to be right, and you'd never be right. Let's take oil, for example. You know, oil has, for the last couple of years, it's been going pretty much straight down. But it's come up a little bit, but it's staying at a range. So if you had put on a strangle up at these strike prices, you would be rolling indefinitely, just stacking up more and more loss. So there's a time to roll and a time to close. Only you can really be that judge, but I would recommend don't do any more than the first roll. So just to recap, I'll just go ahead and pull this over here for us all. when you are trying to manage a strangle that's going against you, the first step is to don't panic. Next, you want to wait for the right time to start making adjustments, generally waiting for the same month as the expiration contract. Your first adjustment should be to roll up your untested side. So if it's a test on the call side, you want to roll up the put. If it's a test on the put side, you want to roll down the call. Next, if your strike gets totally breached, even after making the adjustment in number 3, you could take the option to turn it into an iron fly to maximize the credit that you can receive. Again, without going inverted, but I'm not going to get into that in this stream. So if you go for an iron fly, you can maximize your credit, but you're also going to pretty much make it impossible for you to land on that max profit target. So you're really just going for a scratch at that point just to get out alive. And then as you're going through all these adjustments, keep track of all of the credits by keeping good notes for all your trades, which anybody who's trying to self-educate themselves in the stock market needs to be taking great notes so they can continually improve. And then finally, as expiration gets closer, you have to choose whether you want to take the loss and move on and fight another day, or if you want to try to roll it out in time and give yourself the opportunity to be right. So I hope that was helpful, guys. I really enjoyed walking through this with you, and I'm looking forward to seeing what this little guy has in store for me. As you can see right now, if I roll out, you've got the current price here, and you've got my strikes. It's really flirting with that 43 strike right now. So we'll see what happens. I know this is not going to be the first time this happens, but it's a good one to learn, and hopefully I can teach you guys along the way. So with that, guys, enjoy it. Love learning about this stuff, and just have a good time. Don't take it too seriously, and have a great life. See you guys next time.